Say you are sitting in a 30% tax bracket right now, and every year you put $10,000 into your RRSP because someone told you your tax bracket will be lower once you retire. That single assumption could cost you more than $45,000 in lost old age security payments and extra tax, and most people never see it coming. The standard advice sounds reasonable on the surface. Contribute now while your income is high, withdraw later once your income drops, and keep the difference. That works for a lot of people. It stops working the moment your retirement income lands close to what you earn today, especially if you have a workplace pension or a paid-off home you plan to downsize. There is a name for what happens to you in that zone. I have watched this happen to careful savers who never missed a contribution in their life. I call it the 10% dead zone. If your income in retirement lands within 10% of your income today, the tax deferral advantage of the RRSP does not just shrink. Once you factor in the 15% OAS recovery tax, it can actually flip against you. So if you have ever typed into a search bar something like, "Is an RRSP still worth it if my tax bracket stays about the same?" you are not alone. The honest answer depends on one line most retirement plans never show you. In the next few minutes, I am going to show you the retirement income warning line, sitting right around $83,200, and why crossing it changes almost everything you have been told about RRSPs. If you are between 55 and 65, and you have started wondering whether the CRA is going to end up the biggest winner of your retirement savings, stick around and hit subscribe. This channel is built for Canadians who worked hard, saved carefully, and do not want to hand back a big chunk of it at age 71. There is a number that decides whether the standard RRSP advice still applies to you, and it is $83,200. That is the median after-tax income for senior families in Canada. If your retirement income is going to land above that number, the advice everyone repeats about RRSPs, the advice built for the average retiree, was not written with you in mind. Most of the reassurance you hear about RRSPs comes from median numbers. Financial writers look at the average Canadian household and say, "Do not worry, your income drops once you retire, so you will land in a lower bracket automatically." That is true for someone whose retirement income sits well under $83,200. It stops being true the moment you are sitting on a paid-off house, a workplace pension, and a healthy RRSP balance, because you are no longer the average case. I have sat across from people who did everything the guides told them, maxed their RRSP every single year without fail, and were stunned to learn the refund they loved in their 30s turns into a tax bill in their 60s. Nobody warned them the rules change once your income stops looking average. There is a second number that matters even more once your income climbs, and it is $95,323. That is where the OAS recovery tax kicks in. Cross that line, and the government starts clawing back 15 cents of your old age security for every dollar you earn above it. Picture someone earning $90,000 today, sitting at roughly a 30% marginal tax rate depending on the province. They plan ahead and add it up. A $40,000 pension, $15,000 in combined CPP and OAS, and $30,000 in mandatory RRIF withdrawals. That comes to $85,000 a year, close enough to their working income that almost nothing changed. It does not feel like a shortfall from the outside. The property tax bill still needs paying, the car insurance renewal still shows up in the mail, and on paper this person looks exactly as comfortable as they did the year before they retired. They saved at 30%. They are about to pay it back at something closer to 35%, once you stack the provincial tax and the OAS clawback on top of the federal rate. That is the trade. Every dollar deferred today comes back later with the government deciding the terms, and by the time you find out what those terms are, You cannot undo the decades of contributions that got you there. Now, maybe you are nowhere near the clawback line yet, and $95,323 feels far away. There is a smaller, more common trap waiting before you ever get there, and it catches people earning as little as $60,000. Here is the framework I use with people once they get close to that $83,200 line. I call it the retirement income break-even rule, and it is simpler than it sounds. An RRSP only beats a TFSA or a plain taxable account when the tax rate you pay on withdrawal is meaningfully lower than the tax rate you got the deduction at. Not the same, meaningfully lower. That is where the 10% dead zone comes in. If your projected retirement income sits within 10% of your marginal rate today, the tax-deferred growth inside an RRSP gets neutralized by something people rarely account for, the loss of flexibility. You cannot pull money out of a RRIF only when it is convenient. The government sets a minimum withdrawal every year, whether you need the cash or not. Let me show you the math with a simple $5,000 example. Put that $5,000 into an RRSP, let it grow to $10,000, and withdraw it at a 25% tax rate. You keep $7,500. Now, take that same $5,000, pay the tax up front, so you are really investing $3,500 after tax, and let it grow to $7,000 in a regular taxable account. Only half of that $3,500 gain gets taxed as a capital gain, so after tax you are left with about $6,562. On paper, the RRSP still wins by a bit, $7,500 against $6,562. Here is the part that changes everything. If that RRSP withdrawal is the dollar that pushes you over the OAS clawback threshold, the 15% recovery tax eats into it, and your $7,500 net can fall to something closer to $6,000. Suddenly, the boring taxable account, the one nobody gets excited about, comes out ahead. Picture a year when markets are down and your portfolio has taken a hit. You still have to pull that RRIF minimum out and pay the tax on it because the calendar says so, not because it is a smart time to sell. That forced sale locks in a loss you might have avoided if the money had simply been allowed to sit. This is the version of losing flexibility nobody puts in the brochure, and it is exactly the kind of detail that turns what looked like a clear winner on paper into a much closer call once you are actually living inside the dead zone rather than just reading about it. I used to tell everyone to max out their RRSP first, every year, no exceptions. I was wrong about that, or at least wrong about applying it the same way to everyone. I did not account for how aggressive the OAS recovery tax has become for middle-income Canadians who did the right thing and saved consistently for 30 years. This is not an argument against RRSPs. It is an argument against treating them as automatically correct. The math only works in your favor when there is real distance between your tax rate today and your tax rate in retirement. Inside the dead zone, that distance disappears, and you are left holding an account that trades flexibility for a deferral that barely pays off. If you think the clawback math is uncomfortable, wait until you see what happens to these numbers the moment life throws a real expense at you, a new roof, a furnace, a medical bill that will not wait. Let me put two versions of the same person side by side. Same age, same house, same $80,000 base retirement income. The only difference is what happens when real life shows up and one of them needs $50,000 for a major home repair. The first person does not have a TFSA buffer built up, so they pull the $50,000 out of their RRIF. That withdrawal gets added straight onto their $80,000 income, pushing their total for the year to $130,000. At that income level, they are paying tax at roughly a 43% marginal rate, so the withdrawal itself nets them about $28,500 after tax. Then the second hit lands the following year. Because their income crossed $95,323, they lose 15 cents of OAS for every dollar above that line, which works out to about $5,201 in clawed back old age security. All in, that $50,000 emergency withdrawal really only put around $23,300 in their pocket once tax and the OAS hit are both counted. It does not feel dramatic in the moment. It looks like paperwork, a slip in the mail, a notice from the CRA a few months later showing a recovery tax adjustment. By the time it shows up as a number on a page, the decision that created it happened months earlier, and there is nothing left to do about it. None of this makes the first person careless. They did what most people are taught to do, save inside the RRSP and worry about withdrawals later. The cost here is not a character flaw. It is a sequencing problem nobody warned them about. The second person built the exact same balance sheet a different way. Years earlier, they stopped maxing out their RRSP once they hit their break-even point and redirected that money into a TFSA instead. When the roof needs replacing, they pull $50,000 straight out of the TFSA. No tax bill, no OAS impact. The full $50,000 does the job it was meant to do. Same emergency, same $50,000. One version cost this person almost half their money on the way out the door, and the other version costs them nothing extra at all. This is not just a lifetime problem either. It follows you past the point where you stop needing the money at all. The biggest myth about the RRSP tax bomb is that it only goes off while you are still alive to feel it. Here is a piece of the RSP story almost nobody talks about while they are still contributing. When the second spouse in a couple passes away, the entire RRSP or RRIF balance gets added to their income in that single final tax year. Not spread out, not averaged, all of it all at once. Take a $500,000 RRIF balance for someone in Ontario or British Columbia. Taxed as one lump of income in 1 year, that balance can generate a tax bill of roughly $240,000. Close to half the account, gone in a single return, paid to the CRA instead of passed on to the people this money was meant for. Think back to 2008 for a moment. A lot of people watched their RRSPs drop by 30% almost overnight. What most people did not think about at the time is that the government's share of that account, the deferred tax sitting inside it, dropped right along with it, proportionally. You carried 100% of the risk on that money for years. At the end, you only keep somewhere between 50% and 70% of the reward, and the government collects the rest regardless of how the markets treated you along the way. That is the part that is easy to miss when you are 45 and maximizing contributions every spring. The RRSP is not just a retirement account. It is a partnership with the CRA where they decide their cut decades after you made the deposit, and that cut gets paid whether your investments had a good decade or a rough one. I have talked with widows and widowers who were blindsided by this, dealing with a loss and a tax bill in the same season when neither one was something they had time to prepare for. This is exactly why meltdown strategies, deliberately drawing an RRSP down earlier and more intentionally instead of letting it balloon, are becoming the standard playbook for Gen X Canadians heading toward the finish line. If you want the full breakdown of how that works, make sure you are subscribed, because we are covering it in detail next. Part of why the RRSP myth will not go away has nothing to do with math at all. It is about how good that refund feels every April. You make your contribution, you file your return, and a few weeks later, a chunk of money lands back in your account. It feels like a win. It feels like free money. That reaction is completely normal. The system was built to produce exactly that feeling. Governments know that immediate rewards change behavior far more effectively than a benefit you will not see for 20 or 30 years. So the refund shows up fast, and the tax bill waits quietly until you are much older. I have seen people build their whole spring around that refund without really noticing it. New patio furniture, a bigger vacation, sometimes just breathing room on the mortgage payment for a month. None of that is wrong on its own. It is just worth noticing that the good feeling and the actual financial outcome are two completely different things. Here is the shift worth making. Stop thinking of that refund as a bonus. Start thinking of it as a loan from the CRA, one you will have to repay later with interest. Except the interest is really just growth on money that was never fully yours to begin with. Ask yourself this. Would you take out a loan today if the interest rate was variable and the government got to decide what that rate would be 20 years from now, based on rules they have not written yet? That is what an RRSP deduction actually is. It might still be worth taking. Just make that choice with your eyes open, not because April felt good. Most people, once they actually sit with that question for a moment, answer it a little differently than they expected to. Here is how to figure out where you actually stand. In 4 practical steps you can walk through on your own this month with nothing more than a pen and your own numbers. Step 1. Calculate your floor. Add up the average CPP payment, which sits around $925 a month, the maximum OAS payment, currently $751.97 a month, and any workplace pension you are entitled to. That total is your guaranteed income floor before a single RRSP or TFSA dollar gets touched. Step 2. Apply the 80% rule. If that floor already covers 80% of your current working income, that is your signal to stop pushing new money into the RRSP and start redirecting it into a TFSA instead. You have already built enough deferred income. Adding more just increases the size of the tax bill waiting for you later. Step 3. Make the TFSA pivot. The annual TFSA limit sits at $7,000. Once you have identified that you are close to or inside the dead zone, that $7,000 becomes your priority contribution room every year, not an afterthought once the RRSP is maxed. Step 4. Use the carry forward strategy if it fits your situation. If you are in a lower bracket right now, but you know a spike is coming, maybe you are planning to sell a business, or you are expecting a large bonus, you can still contribute to the RRSP without claiming the deduction immediately. Bank that deduction and use it the year your income actually spikes, when it is worth far more to you. Write these 4 numbers down somewhere you will actually look at again, not just in your head after watching this. Your floor, your 80% comparison, your TFSA room, and whether a carry forward makes sense for your situation. 15 minutes with a pen and your last notice of assessment tells you more about your real dead zone risk than any general rule of thumb ever will. Most people think the choice is RRSP or TFSA, one or the other, forever. It was never really that kind of choice. It is a question of timing, and the people who get the best outcome are the ones who revisit that timing every few years instead of setting it once in their 30s and never looking at it again. The myth was never that the RRSP is a bad account. The myth is that it is automatically good for everyone, in every situation, forever. If your retirement income is going to land anywhere close to that $83,200 median, or anywhere near the $95,323 clawback line, the math changes, and the advice has to change with it. If you already stopped or slowed down your RRSP contributions somewhere along the way, you are not behind. You are not the person who did it wrong. You are the person who noticed the math shifted before the tax bill arrived instead of after, and that puts you ahead of most people, not behind them. That is the kind of quiet win that never makes headlines, but it is the one that actually matters over 20 or 30 years of retirement. That is really the whole point of running these numbers early. Keep the money in your pocket for as long as you reasonably can, not the CRAs. If this helped you see your own numbers a little more clearly, subscribe to Brian's Canadian Retirement Playbook. There is more of this coming, built specifically for people doing exactly what you are doing right now, trying to get this right before it is too late to adjust.